Who can you trust? Are you experiencing an increasing level of distrust of people and organizations? I am. It seems that those who have betrayed our trust are everywhere, in every segment of our lives and our economy. When betrayal happens, it leaves people with an increasing level of distrust. Maybe this is happening with you. Have you been misled, betrayed, abused, and outright lied to for someone else's gain? Do you believe this is much, much worse than it has ever been? Hi, I'm Ben Reppond. Today is August 16, 2022. Welcome to my YouTube broadcast. I'm going to cover this area of trust, betrayal, dishonesty for other people's gains. I thought about it because of a personal situation that happened to me that caused me a level of distrust because I was not told the truth over and over again by an outside party. I thought of several areas. If I were to list all of the areas where in our economy and in our world that's around my little world and your little world, it would be a long list. It could be 10 or 20 different areas, but I just listed 6, and I wanted to just cover those with you with some examples of things that have either happened to me or that I've observed in other people where trust has impacted people's ability to have confidence in another person. First of all, the betrayal or breaking of trust can happen with friends, family members, close family members, or maybe extended family members, spouses, ex-spouses. And when betrayal happens, when the breaking of trust happens, somehow what we want to do in trusting again is diminished. It's sort of like a grain of sand gets put on the distrust side of the scale. I think of doctors in hospitals. It used to be that we could trust our doctor and we never worried about trusting our hospitals. But today I am seeing many, many examples of people who have died or who have become severely ill because of the way they have been treated or diagnosed or surgeries or whatever by the medical community. It seems like it's almost more the norm that the medical system is failing people. Now, when I say that, just like with everything, all of my examples, I'm also going to say I don't know what percentage this is. There are obviously doctors, nurses, hospitals, those within the medical community who are trustworthy, who are trying to do the right thing, and who are excellent providers in whom we can trust. However, it seems to me that there is an increasing level of those who are betraying our trust, whom we can't trust, to the point where it makes me wonder, who can we trust? I thought of a retail example and I think whether you buy products online or you buy them at a store, over and over again, things seem to not be what they appear. We appear to be marketed to, and the quality of what we get is not what we thought it was. That's another form of lying. It's another form of breaking trust between the deliverer of a good, the seller of a good, and the purchaser of a good. Reminded me of an example I had many years ago. For a long time, I had bought clothes and shoes at Nordstrom. Nordstrom was a very quality organization. You would get clothing that was quality at a fair price, and they stood behind it. They were known for that. And then they went public, and then they wanted to get their stock price up and up and up. And what happened was the price of goods seemed to go up and up and up and up quite a bit, while at the same time the quality was being diminished. And what they were selling was being made in third world countries, and the quality of what they were selling was, it just was not what it used to be. Now, I'm speaking in the clothing area. There's other areas of departments and so forth. But in the clothing area, it was, to me, noticeable over time. One time I went in, I wanted to buy some t-shirts. And I'd bought t-shirts for a long time at Nordstrom. And when I got the t-shirts home, I took them out of the package, I held them up to the light, and I could literally see everything on the other side of the fabric. Everything. It was as if there was no fabric there practically. And so I couldn't believe it. And of course, I remember a time when you couldn't see anything on the other side of the fabric. I'm okay if they're made in a third world country at a lower price. That doesn't bother me. But in order to squeeze a few more cents out of that product, they not only had them made very cheaply, but they diminished the quality. I took those t-shirts back to the customer service department and said, I'm going to turn these back in. I want a refund, and here's why. They gave me the refund, and as I walked out, I said to myself, I will never come back to this store again. And I never did. And that was another experience of the diminishing of quality and the diminishing of trust, when once there was trust. In the media, there was a time, see, I go all the way back to Walter Cronkite and David Brinkley and Chet Huntley and those days, and it seemed like at that period of time, of course, there was no social media or digital media or blogs or anything. There was just TV, right? And so, but I remember that when I would watch the news on TV, I trusted what they said. It seemed to be right. I don't know if it was, but it seemed to be. And there was just this level, they inspired a level of trust. And over time, that diminished. And to the point where the news media and the blogs and the internet sites, wherever we get our information from and our news from, just seem to be filled with information that I wasn't sure was correct. And then I would see information here and here that contradicted each other. And of course, there was agendas. I couldn't find anything without an agenda. That was just straight down the middle, no agenda, no bias. I still can't find it. But the news that I was getting was, in my opinion, less quality. So as I watched that, my willingness to trust what I was watching diminished. Another grain of sand on the distrust side of the scale. And of course today, I've told you before, I got rid of my TVs, and I think that helps. But I still access information online, and I check different news sources because I want to try to get a balance, and I'm trying to find out where's the truth. The truth is probably somewhere in the middle. And then in religion, we want to trust, if you're a religious person, you want to trust your pastor or your minister or your priest. You want to trust that person. And many, many of them are trustworthy. They're wonderful people. They're wonderful servants. And I don't want to say that that is not the case, because I believe it is. However, there is a certain segment, a small segment, that has betrayed people, diminished people, abused people. You know what I'm talking about. And that has lowered our trust meter of those who are in areas of service, in churches. And when we see that, there is an increasing level of skepticism of, I wonder who this person really is. And then I get to my area, the area of financial advisors, of which I'm a part. I have people call me from around the country. I have conversations with people, and I very much enjoy that. Over and over again, people are telling me how they have been, I'll say, lied to, not told the truth. And this past year, 2022, they've had a chance to see the story that they were told, the expectations they were given, and how that played out in reality. Over and over again, people's trust has been diminished because those in the financial, not everyone, but the ones I've talked to, in the financial advising industry have betrayed them. They have said one thing and something else happened. Maybe they were overly optimistic, but it seems that they've got this down to how to help themselves to your money, to make money off of you, and deliver to you an experience which diminishes your trust. I don't think that's a good thing. So I come back to, so what can you do? What can you do about all this? I see this as sort of a fork in the road. And in the fork in the road, there is one side that is you can not trust. You can just say, my willingness to trust people in almost every area of life is so low, I just don't want to trust anybody. That's an option. The problem for me, I'm not going to go that route, because the problem for me is that's a lonely existence. If you can't trust anyone and choose not to trust anyone. So I go to the side of, I do want to trust. But then I come back to, so what can I do about these kinds of experiences? How can I have a better experience of life knowing that I want to trust and that there's a lot of untrustworthy people out there? I wrote down some areas that I will share with you of how I look at it and what I try to do. So even though I have tried to diminish this area or to protect this area in my life, I still find myself being subject to being lied to, being told information which is incorrect. Even though I try to protect myself from it, it still happens. So the first thing I wrote down was, I'm going to trust, but I'm going to do it more carefully. Even though I've done it carefully in the past, I'm going to do it even more carefully. I'm going to do it cautiously and judiciously. And I will still probably make misjudgments, but I'm still going to trust at some level. I think I can limit the scope of my trust. So instead of just trusting everyone on a more cautious basis, maybe I'll just limit it to a smaller group of people so that the scope of it is less. Thirdly, I can seek to verify information that I am told. Verify it with in more than one place. The information or impressions that you get, those can be checked. And so maybe my due diligence and my verification of information should be better than it has been in the past. Fourthly, even more than in the past, I will listen to my gut, my intuition. If there is a little bit of a check in my spirit, then I should listen to that. And finally, I do, and I've done this in business over many years, do scenario assumptions. What is my downside? What is the worst case scenario if I trust this person? It's a fair question. It's a question for myself. Or, what is my downside if I don't trust this person? Because either way, I'm making a choice. Trust or don't trust the information or the person. And what is my downside in each case? Gives you some ideas to think about as you evaluate for yourself who you can trust, how much you want to trust, and do you want to trust? I'm going to shift gears. I want to show you this. This is a quote from Carmen Reinhart. Carmen Reinhart was born in Havana, Cuba, a long time ago, immigrated with her parents to the United States, raised in South Florida, got her bachelor's degree in Florida, and then her master's and doctorate at Columbia University, and is now the professor of international monetary systems at Harvard. She is also the chief economist for the World Bank. She said this: the essence of the "this time is different" syndrome is rooted in the firmly held belief that financial crises are things that happen to other people in other countries at other times. Crises do not happen to us here and now. We are doing things better. We are smarter. We have learned from past mistakes. The old rules of valuation, and she's talking about equities or the value of companies, the rules of valuation no longer apply. Unfortunately, a highly leveraged economy can unwittingly be sitting with its back at the edge of a financial cliff for many years before chance and circumstance provoke a crisis of confidence that pushes it off. I'm going to restate this. I'm going to add a few words for relevance and clarity. Think about it. The essence of the "this time is different" syndrome is rooted in the firmly held belief that financial crises are things that happen to other people in other countries at other times. Crises do not happen to us here in the good old US of A, here in 2022. We are doing things better. We are smarter. We have learned from our past mistakes. Well, we have evolved. The old rules of valuation no longer apply. Unfortunately, a highly leveraged economy, like we have right now, can unwittingly be sitting with its back at the edge of a financial cliff for many years, maybe decades, before chance and circumstance provoke a crisis of confidence that pushes it off the cliff. And here we are now. Professor Reinhardt wrote a book, co-authored it with Professor Ken Rogoff of Harvard, and the book is entitled, "This Time is Different: 8 Centuries of Financial Folly." I had to read that a second time. Not 8 years, not 8 decades, 8 centuries of financial folly. I've taken you back on data and charts back sometimes 100, even 150 years. 8 centuries of financial folly. And what she's referring to is debt. In the book, as they go back over the past 8 centuries, they chronicle, document the collapse of countries, civilizations, empires over that period of time, and it always comes back to debt. Today, for the last 100 years, we have added another element of debt, which is our central bank, the Federal Reserve, because they are leveraging their balance sheet with nothing behind it, which is called debt, and the government is, of course, digging a deeper and deeper hole with more and more debt. She and Professor Rogoff in the book are astonished that somehow there is this paradigm, this belief, this behavior that people adopt, those in power adopt, that this time is different over and over and over again. Countries, leaders of countries make the same mistake over and over again, piling up debt, too much debt, and then eventually the weight of that debt collapses the country. But they have the belief that somehow this time is different, and it never is. She's up in the Boston area. I imagine this. Wouldn't it be amazing if somebody from Congress called her and said, "Professor, could you bring Professor Rogoff and the two of you come down to Washington, D.C.? We'd like to talk to you. We'd like to learn more about this idea that we have too much debt and how we could actually preserve our culture, our country, by reducing our debt." Can you imagine that conversation? I can't. I don't think those in power have any interest in reducing debt. They seem to just pile it up, trillions upon trillions upon trillions, with no concept of how to repay it and how to repay the interest. In a way, appalling, because you and I don't run our households like that, but the government, not just our government, but all governments, everywhere, as I chronicle in the book, everywhere, people or countries, leaders, pile up debt that cannot be repaid. This time was very tempting because interest rates were so low for a prolonged period of time. It was very easy to pile on debt because there was so little interest being charged. Well, that's changing now. It's just beginning to change, and it's going to change a lot more as interest rates increase even further. Okay, I'm going to shift gears from these two subjects of trust and this time is different over into a couple of videos. The first video I want to show is with Mohammed El-Arian, who is certainly a world-renowned expert in financial matters, and he takes a look at the Fed and the inflation and interest rates and where are we in the cycle. Should the Fed in fact be raising interest rates or not? How severe is the problem of inflation? So I'll play this clip from Mohamed El-Erian.
Good morning to you. What do you think here? Is the Fed actually going to slow down?
It's not. The Fed is going to have to consolidate its gains. Yes, gains because headline inflation came in better than expected. They can't celebrate. In fact, you've had a few Fed speakers come out already and say it's early days and we're not going to stop hiking. So I think the Fed is going to welcome the latest print, but it's not going to slow down in any significant manner.
And so when you say not slow down, we're at 75 basis points in your mind, or we're at 50? Because that seems to be the big debate.
Somewhere between 50 and 75, but that's a lot, Andrew, when you think we've already had two 75s. Look, the Fed has had a couple of really good data reports. The jobs report and, of course, the inflation, which suggests to them that they can continue doing what they're doing because the underlying strength of the economy is still significant, and that's important.
So when you think about where we are right now, I mean, there is a view in the equity market right now. You've seen how fast the market has come back. And some people think the train has already left the station. Has it left the station, or is it going to return to the station based on some of your perhaps pessimism about where we really are in the economy?
Okay, so we've had an incredible rally. And the first stage of the rally was all driven by technicals and relative valuations. What's encouraging is that the latest stage of the rally was driven by less worrisome fundamentals. And that's a good thing. That has more legs to it. Looking forward, Andrew, I think it's too early to call the recession risk over. I think there are significant headwinds coming. And the other thing about the inflation number, as much as I and others rightly celebrated the headline inflation, core inflation is still worrisome. It went up. It went up to 5.9%. If you look at the Cleveland Fed's measure of trimmed inflation, that also suggests that inflation is very broad-based. So what you're really getting is the energy prices coming down, and that is what resulted in the zero inflation month on month and the decline to 8.5% in the headline. But the underlying drivers of inflation still remain strong and broad-based. And the PPI number is going to be important in this.
Then I want to give you a piece of good news. You know this, that the price of gas and diesel have come down significantly. Then I'm going to show you some data after this. But this is just a brief video clip that will show you just a news clip from CBS and about the perception from that gas prices were really going up fast, and now they seem to have come back down. You probably have noticed that. And so here's this clip from CNBC Evening News.
We do have some good news for drivers. AAA says the average price for a gallon of regular gas dipped below $4 for the first time in 5 months. Here's CBS's Errol Barnett.
Today, $3.99. It's good.
It is a rare glimmer of financial hope for those frustrated by fuel prices.
What does it feel like to get at least this small bit of relief?
It feels good. You know, I got a little extra money.
The national average for gas dipping below $4 today, almost 2 months after hitting a record high. Relief stemming from an increase in global oil supply and decrease in fuel demand, helping to lower the rate of inflation.
How encouraging is that news to you?
Well, it's great. The trend is good. The trend is your friend. But we are not out of the woods yet.
CBS News business analyst Jill Schlesinger warns the bigger economic picture remains perilous.
The problem that we see in almost every category is that you can look at a given month and say, phew, we're down from the peak. And yet when you look back a year, it's still stunning.
While lowering in the past month, compared to 2021, gas prices are up 44%, and airfare is 28% more expensive.
You're still paying more than you were, 2-3 years ago.
Average rent costs have jumped 14%. It's twice as high in places like Cincinnati, Seattle, Austin, and Nashville.
There are millions of Americans who will continue to be under pressure until we see that inflation rate come down.
And to Jill's point, a third of Americans are now spending their savings to cover all of these increased costs, according to one survey. And while the price of regular gas has come back down to earth recently, diesel, which is the lifeblood of transporting goods all across the country, is 54% more expensive, Margaret, than 1 year ago.
Errol Barnett, thank you.
Okay, to make the point further, this chart shows that the price of gas has come down, this is a national average, from about $5 for regular, come down from about $5 a gallon to about $4 a gallon. That's a lot. Just in the past couple of months. So that's amazing and welcome good news. And that has had a dampening effect on the level of increasing inflation. When I jump over from gasoline over to food prices, the UN World Food Price Index, you can see, has also come down. It was going up, skyrocketing up, and it has had a correction. And that's illustrated, this is through the month of July, this is illustrated at the right side of the chart. In the stock market, there is what is called a smart money flow index. And the institutional investors, the big money, has started to buy stocks more. So we've had a period of time of a month or so where stocks have been on the increase. And that's welcome good news. And this chart shows the money, it's an index, okay? It doesn't relate to any particular item, it's just an index. And so you can see that the degree to which recently, in the last month or so, that index has gone up very sharply. Again, good news. When I get to labor, this is a labor force participation rate by age. You can see that this goes back about 20 years, back to 2000, the participation in the labor force has primarily been from those age 65 and over. Isn't that interesting? And then the next closest group is 55 to 64, and those under age 55 collectively have diminished in the workforce over the last 20 years. I don't think that used to be the case. I want to show this slide. This is the U.S. Producer Price Index, month over month. This is called the PPI. As consumers, we're familiar with the CPI, Consumer Price Index, measuring consumer prices, but this measures producer prices. This has, in the past month, was expected to be slightly positive, but actually is quite a bit negative. The actual came in worse than expected. So, not a good indicator for the economy, but it is the data. The National Federation of Independent Businesses measures their constituency is made up of small businesses. And so this is I'm going to show you 3 charts of the NFIB, and this shows their optimism. This is a survey of small business owners. How optimistic are you about the future? And you can see where that chart has gone. This shows the earnings, the profit of those companies measured over time as reported through the NFIB compared to historical periods. So profitability has diminished. We could surmise about the cost of goods, the willingness of customers to pay a certain price for those goods, and the cost of labor, etc. So, but anyway, there's a change in earnings that is negative. And then sales expectations. So when these owners of small businesses are surveyed, how do you expect your sales to be in the future? You can see where it is, and it is now down at the level of close to approaching 2020, at that second quarter of 2020, and 2008, 2009. Not a good picture. I want to play another video for you. This is from the Tom Barkin, who is the president of the Richmond Fed, one of the regional Fed offices, and he is making the case for more rate hikes, that to deal with inflation, he's not being overly optimistic, he's being cautious and saying, basically the way I read it is, we're not through the woods yet. We're not out of the woods yet. We're not through this issue yet. But they look at data on a regular basis, but you can listen to his cautionary comments.
President Barkin, good to have you on this morning.
Thanks for having me.
Well, we've just gotten, obviously, a week of relief on some inflation measures, naturally CPI, PPI index, University of Michigan sentiment. The inflation expectations did moderate to some degree. That follows the New York Fed survey in a similar direction. How does this all filter into your view of whether the Fed is on course to get inflation back to target, what it means for policy in the near term?
Well, Wednesday's data, the PPI data yesterday was all very welcome. So we're happy to see inflation start to move down. And I'd like to see a period of sustained inflation under control. And until we do that, I think we're just going to have to continue to move rates into restrictive territory.
Period of sustained declines in inflation, I guess you mean, so multiple months. How are we going to know when we're there?
Well, you'd like to see inflation running at our target, which is 2% on the PCE. And so I'd like to see it running at our target for some time.
You say we need to get shorter term rates into restrictive territory. Do you agree that at the moment we're in the zone of neutral? And I suppose, how do you think the economy is set up to absorb that move into restrictive territory?
Well, you know, there's a wide range of estimates of neutral. And so a lot of times you learn about it when you're doing it. But I think there's still more to come to get into restrictive territory. The economy seems to be weathering it well. There are obviously sectors that are more impacted than others. But if you look at the jobs report and you look at the other data we've been getting over the last several weeks, it still seems like the economy is in a fundamentally sound place.
Tom, that's my question there, is this idea that if the labor market is so strong, if there is such tight supply in the labor market, does that present a floor and present a challenge to the Fed's ability to actually get to that 2% level in controlling inflation? Even though wages haven't kept up with the pace of inflation, it's still a very, very strong labor market right now.
Well, I guess I just start with inflation, and a tight labor market doesn't have to cause inflation. We certainly had a tight labor market in 2018 and 2019. And inflation is being driven by commodity prices, as you know. It's being driven by supply chain issues, as you know, and it's being driven by demand. And so as we move rates and try to normalize demand, hopefully we'll get some help from those other two lanes as well. And then it wouldn't be inconsistent with a tight labor market at all.
Okay, now I want to show you this past week, the flow of funds report. This is where is money, the majority of money going, the net amount of money going into and out of in the market. Conventional equity funds, and this excludes ETFs, conventional equity funds had net inflows of $4.4 billion. Well, the market has been going up, so money is going to chase that, and so there is a net inflow, 4.4 billion. Bond funds have had net inflows of 3.8 billion. Money market funds have had net outflows of 11.9 billion. So money is going from the sidelines in general into the equity market and into the bond market, more so than it has been in the past 6 or 8 months. Now I want to go to my dashboard and my charts. This shows, not unlike what I just covered, that you can see on the red or green dots on the right where these averages are, these ETF averages are relative to their 20, 50, 100, and 200-day moving averages. If they are above that average, particularly if they're rising above that average, which in this case they are, it is a positive sign. If they're below the average, then that would be a red dot. It's not a good sign. So I measure, this kind of goes in descending order of rate of return. So the most favorable for the year to date in the, I guess it'd be about the 5th column over, the most favorable is the Dow Industrial Average. Through Friday, the Dow was down 7%. IWM, the Russell 2000 Small Cap Index, down almost 10%. SPY, the S&P 500, down about 10%. EFA, the developed countries, international countries, down 15%. EEM, the emerging markets, developing countries, down 15, almost 16%, and the NASDAQ 100 down almost 17%. The S&P 500 is made up of 11 sectors. I take these 11 sectors and put them on that same scale, 20, 50, 100, and 200-day moving averages, and show where that ETF representing that index or that sector is relative to the moving average. And last week, there are 44 options because there's 11 sectors and 4 different moving averages per sector. And so the total of 44 possible outcomes. Last week, there were 26 green dots. This week, there are 35 out of 44. So the market has been moving up, and it has been moving up sector by sector. The top 4 are above all 4 moving averages: energy, consumer staples, healthcare, and industrials. And then some others are above 2, and some are above 3. So you can see definitely an improving picture across many sectors. Now I'm going to jump over to charts. This is a chart of the S&P 500 and over the past year. It's a weekly chart. 1 move equals 1 week. I put through that chart the 20-period moving average. So you can see that the chart in general has gone down somewhat, but now a new trend has emerged in the past few weeks. And I put that, I referenced that with the black arrow on the lower right part of the chart, showing that it is actually going up at a pretty good rate and has crossed over its 20-period moving average and seems to be headed in an upward direction, at least for now. This is a relative strength or relative performance chart comparing the growth side of the S&P 500 to the value side of the S&P 500. SPY-G, the ETF, SPYG, is the numerator. The denominator is SPY V, the value side of the S&P 500 index. So when it is moving up, that favors growth kinds of stocks in the S&P 500. When it is moving down, it favors value stocks. So it goes up and down. And you can see and this is a period of 12 months, and it is a weekly chart. So you can see over a period of about 8 or 9 months that the value has been in favor. Growth has been out of favor. However, it hit the bottom and now seems to be moving in an upward direction, which is favoring growth stocks. Growth stocks in the past several weeks have been more in favor than value-oriented stocks. This chart goes over a 24-month period and also it's a relative strength, relative performance chart of the small cap index, the Russell 2000, represented by the ETF IWM as a numerator, and SPY, the S&P 500 ETF, as the denominator. So you can see in this 24-month period, so you can see over about a let's see, what is that? About a 17-month period of time that the small cap has been out of favor. But in the past several weeks, it is starting to be stronger than SPY. So this is pitting the small cap stocks against the large cap stocks. When the small cap stocks are rising, it generally means there is more of an appetite for risk because money is flowing more into small cap, which are generally considered riskier than large cap stocks. So you can see at the end of the chart, I drew a black arrow so you could see the emerging trend, and maybe it is a trend, that is starting to emerge in favor of small cap and also moving kind of in favor of the willingness of money investors to take risk. This is not a relative performance chart. This is an absolute chart of a 30-month weekly chart of the long-term government bond ETF, TLT. And I show two trends in this 30-month period of time. You can see that long-term government bonds are declining. They are declining, and this is what has caught financial advisors flat-footed, and portfolios have declined more than normal, is that this was not anticipated. And so it does not spell good news for static, buy and hold, traditional type portfolios. And the arrow on the far right shows that on a weekly basis, long-term government bonds, which is an indicator for other bonds as well, continue to be on the decline. Now I'm going to cover gold. Go back to a 12-month chart, an absolute chart for gold, represented by the ETF GLD, and you can see that recently in the past few weeks, gold has been on the increase. And that's good news because for the past several months, it has been declining in value. It looks like maybe it has hit a bottom and is on its way back up. And silver, the same thing. It has been in a period of decline for the past several weeks or past several months, and it is now also on the increase. When I compare those two, I push this out to a 24-month chart, and you can see the long-term, maybe 18 months or so, represented by the red line, and that gold is in favor. Gold's in favor when it's going down, silver's in favor when it's going up. And you can see at the end of the chart where silver is now not only going up, but is going up at a faster rate than gold is. but the long-term trend over the last 18 months or so has been that silver has not, or has decreased more than gold has. I show the volatility index. The volatility index is a measure of risk in the market. As it declines, then that means risk is diminishing from the market, and vice versa. The black line is a generally agreed upon area where that if the volatility index is below the black line, then it is more, volatility is starting to come out of the market. And that has been the case for the past 2 or 3 months. Asbury Research does some metrics, measurements of the market. They have 6 of them called the Asbury 6. And this shows that 5 out of their 6 are positive, again, echoing the same message that I've just been covering. However, I want to point something out. The one that is red is trading volume. And I've noticed this with the S&P 500 SPY in particular, that the increase in the past several weeks, while it has been going up, it has been going up on weak volume. There is not a conviction in the market that the market really truly wants to go up. The big money is not coming into it enough so that the volume, when measured against the last 90 days, is, I think, only 3 or 4 days in the past month and a half that have been above the average rate of volume. So it tells me that probably quite a bit of that volume is coming from short covering. Money traders that were short the market are now having to cover those short positions because it is getting more and more painful. And that's not a conviction of buying. It's more of a prevention, a loss prevention technique. So I would issue a word of caution about the market. While it's positive, it's not showing the level of conviction that we are entering a new bull market, or that we were in a bull market all along and this 20-25% correction was just a correction and that we're continuing on the same bull market. I don't believe that. I believe we are in a bear market and that this is what's called a bear market rally, a relief rally. It'll go up for a while and then, like all bear markets, will collapse at some point. We don't know the future. I obviously don't know the future, but I'm just saying what it appears to me that because of the lack of conviction and trading volume, that this is truly, in fact, a bear market rally, getting the market set up to pull in more and more retail investors, and then the selling will resume again. The relative performance chart on assets in Asbury pits various types of assets against others or types of equities against other equities. And I'll go through this because it shows on the 3 columns on the right what is more in favor. And the 3 columns are the weekly, the monthly, and the quarterly view for the past week, month, or quarter, which one is more dominant. Stocks, more dominant than bonds. High beta, higher risk stocks, more favorable than low beta, lower risk stocks. As I showed you in the previous chart, small cap is more favorable than large cap. The S&P, more favorable than the Dow. And then the U.S. market is more favorable than the developed and emerging market. In the area of bonds, fixed income, corporate is more favorable than government, and high yield, higher risk, high yield is more favorable than corporate bond prices. And So all of this has shifted in the last couple of months. Everything was different 2 months ago. But this, again, spelling generally a favorable picture, at least for right now. U.S. versus the world. This is real interesting because the U.S., while the markets have been favorable, and as I showed you, it is slightly more favorable for the U.S. versus the emerging markets and the developed markets. When you really look at the degree of that, the degree to which the U.S. is more favorable than those, it isn't much. It's not enough to get one green box. New Zealand got a little bit, but other than that, the U.S. is in favor, but not much. So there is a lot of parity, actually, between U.S. and other markets around the world. Gold and silver, spot prices as of Friday, gold 1806, up 4%, 4.4% over the previous week, and silver crossed over the $20 mark and is up 4.7% for the past week. Again, another good week for precious metals. Carmen Reinhart talked about the 8 centuries of financial folly, which all seem to center around debt and the unwillingness of countries to learn from the mistakes of previous collapses. This is a visualization, a simulation, showing the degree of debt that we have. If there were, in a simulated fashion, if there were pallets of $100 bills, pallets stacked high with $100 bills, look how high those skyscrapers would go. One after another, after another, after another, sky high. And you can see the a couple of semis down at the bottom of the chart with people. That will give you a sense for the magnitude of debt that we have. And we're piling on. I don't know the exact number, but our debt is about 30 trillion. I don't know for sure that there's 30 of these skyscrapers because I'm not able to count all of them, but let's assume there are 30. If there are 30 skyscrapers here, how many are we adding every year, ignoring interest, ignoring the paying back of debt, ignoring the idea that we shouldn't be adding any more debt? We're adding $2 to $3 trillion a year at this point. Amazing. In my opinion, absurd. Ridiculous, because it has been documented very clear for a long, long period of time that civilizations collapse under their own weight. And this is a representation of how much weight there is on us. And it is not just us. It's every significant country in the world, developed and underdeveloped. It's everywhere. And so when there is a talk about a financial reset, a currency reset, it's because of this. And when you compound this with the Fed, who has its own problem of printing money, and compound it with the fact that nearly every country in the world has the same problem, some a little more than us, some less than us. But it begs the question about the stability of currency in the world. Thank you for watching. I appreciate those of you who have left comments, especially your kind comments. I appreciate those. I will try to answer as many as possible. And again, thank you for watching.